Sell, 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 everybody panic! Did you continue to hold to collect the many, many tendies that were inevitably coming your way? What's up, guys? I'm Ben Sund. Welcome to my channel where we talk about improving our overall financial health through personal finance, investing in real estate, and maybe having a little fun while we're at it. Well, guys, it's done. It's over. It's finished. The GameStop play is done. So for those of you that are thinking, what is this dude talking about? We're going to go over exactly what happened, just as a brief overview. I know a lot of you have probably been following it, but just in case you knew a little bit about it, but didn't know exactly what happened, and then you see a picture of a ginger pointing to stuff on the screen and you're like, that guy looks really cool. I'm going to click on his video. So guys, honestly, I've recorded this video like 6 or 7 times over the last couple weeks. This situation was moving really fast and I didn't exactly know how to present the information that would be unique or give a different perspective than everyone else out there. Again, I'm sure a lot of you have heard about what was going on, but maybe didn't know exactly what happened. And again, we'll get into that in just a second. But I decided that I think we should use this as a case study to determine how we want to invest, or use it as lessons to how to invest or how not to invest going forward. I think that Wall Street Bets did a lot of good things, and it also meant a lot of bad things, honestly. And I think Wall Street, which I think a lot of us already have a problem with, this play helps solidify some of our already preconceived notions. And I think it was a big eye-opener, and I think that there's a lot to glean from that. I think that it's going to change the way that a lot of people, or maybe not change the way, but where a lot of people decide to put their money. So I think Kevin O'Leary said it best. He made a post on LinkedIn the other day, and now I'm paraphrasing, but he said that 100 million Americans don't have an investment account. They have nothing saved for retirement. And now me extending on to that, if you look at savings accounts and emergency funds, most people don't have active emergency funds or savings, and they can't come up with $1,000 in the event of emergency. He basically goes on to say that we have failed them as a society. We teach them almost everything in high school and college but financial literacy. And relating that back to GameStop, you now have a situation where politicians, the press, and the Wall Street establishment are criticizing Reddit, our Wall Street Bets, and Robinhood for trying to create an entry for millions of Americans who have nothing and want the opportunity to invest, but are turned down by most financial services institutions because they don't meet the minimum $5,000 or $10,000 requirement and are no longer seen as profitable customers. This is where Reddit comes in, and the individual, the retail investor, and this is what leads us into our brief overview. So I've been pontificating and quoting and mentioning Wall Street and our Wall Street Bets. So this brings us to what actually happened. Let's jump into the brief overview. A lot of you guys may already know this, but some of you may not. And so let's talk about where it all started. Well, a Reddit forum, specifically a subreddit called Our Wall Street Bets, an investment thread. Now, stop on over there and you'll see exactly why I air quote investment. Look, I love Our Wall Street. I've been following it for a long time. I like it. I love it. Give it to me. I want some more of it. So Our Wall Street Bets decides to stick it to Wall Street. And so what they do is they go on and find the stocks with the biggest short position, and they decided to take a long position. Now, what a short position is a group of investors, or in this case a hedge fund, thinks that a stock, in this case GameStop, is worth less than what it's currently trading at. At the time this all started, GameStop was at like $16 a share. If I'm wrong, it was like 18. And the investors thought that it was worth less. So let's use an example. I have stock A. Let's say stock A is worth $10. You think stock A is going to go down in value. So you come to me and you say, Ben, let me borrow your stock A for 1 month. And in return, I'll give you back your stock A plus $1 a month from now. I say, you know what, Barry? That sounds like an amazing idea. Let's do that. Here you go. You then turn around and sell my stock A for $10. Let's say you're right. It drops to $5. You then hand me my stock A back plus my $1. You just made a $4 profit. So that's what shorting is. It's an investor betting that the stock is going to go down. So they borrow the shares, and when it goes down, they rebuy them with the promise to pay an additional fee. So the opposite of a short position is a long position. This is essentially the position that Reddit, our Wall Street Bets, and the retail investors took. And what that is essentially you think that the stock is going to go up in value. This is what most 401k investors, IRA investors, mutual fund investors, most people in the market are making this play. You buy a stock or a group of stocks and you hope it goes up in value. You benefit for your retirement and the company benefits because they are getting extra cash flow to do R&D, to invest in future products or hire new employees or just general growth. It's having faith in a company and you're putting your money behind that. So back to our Wall Street Bets, that long position that they took, that increased in activity started making the stock go up. It was supply and demand. They got together and they started buying a bunch of the shares, which made it seem like there was a lot more interest in that share. And so it started going up in value. Now, keep in mind that the short position, this was a massive, massive, massive short position. There was something like 72 million shares shorted. So when our Wall Street Bets got together and they started buying all these shares and making the price go up, that meant that if Wall Street or these hedge fund managers had to repay or rebuy the shares at that higher price, I think at the time it got up to something like $350, $400 per share. And so if Wall Street had to rebuy those shares instead of $16, it was $500 or $400 plus the fee that they promised whoever they borrowed those shares from. That meant that there was huge losses. And that's where you start seeing all the panic set in because Wall Street and the Wall Street establishment is seen as the sort of established investor, right? Like we don't necessarily love them and we don't necessarily trust them, but they've been around for a long time. And when you see on all the news channels and CNN and CNBC Money talking about this and talking about how they're losing billions of dollars and how detrimental it is to society and the downfall. And they pitch Reddit as the rogue, the unsophisticated, uneducated investor. So when you hear all that and you see all that and you see these hedge fund managers going on these big media news networks saying that it's a bunch of online rebels undermining the economy and we're going to go bankrupt and everyone's going to lose millions of dollars. Well, it couldn't be further from the truth. Now, what Reddit did isn't good long term. It's what's called a pump and dump. Not legally, but effectively that's what it is. And while exciting now because pump and dumps and shorts and all these things happen, it doesn't happen at the scale of what Reddit did it. Now, you might be thinking like, dude, like, why? What's the point? Like, everything was fine before. Like, why screw with this? Well, a few things. Generally speaking, short positions, specifically to Reddit and like retail investors, are seen to provide no value to the market. They are seen as malicious or nefarious. Usually, again, like we said before, when you invest in a stock, you're investing in that company. You want that company to do good because you also do good. Well, in a short position, you're investing against that company. And you're basically saying that they are not worth as much. Meanwhile, you profit from that. And Reddit wanted to stick it to the hedge fund guys who were doing that to companies. Now, the explanation that I just gave you does sound bad, but shorts happen all the time and they do have real market value, and that's to value a company adequately. Now, remember that just because you hold a short position doesn't mean that the company's automatically worth less. It just means that you think through whatever information that you gained could be that it means less. Now, you could be wrong as an investor, and Reddit is example one of how that's possible, right? Now, a company could be worth more because there might be information that you don't have. Let's take, for instance, a government contract. Let's say a company is working on a new government contract. Well, that isn't necessarily going to be released to the public, but that could create more value in a company. Now, on the flip side, let's say you know that a company is going to be losing a big government contract, and this is a big piece of their revenue. Now, it's going to happen either way, but from an investor standpoint, you might as well make some money. I'll let you reserve your judgment on whether or not you agree or disagree. I'm just bringing this to you because this is Reddit's perspective. This is how it all started. So where do we go from here? Well, as I said earlier in the video, I think this is a really good case study, and I think that the lessons learned from this, if taken and applied to our everyday investment or our long-term investment strategy, can help make us more disciplined, less emotional, and overall better investors. And obviously, whether you're a professional or just a home investor looking to save for retirement, those are the strategies: consistency, investing over time, and being disciplined and not emotional about the trades that you make are going to make you more successful when it comes to meeting your goals. So one of the best things that I think came out of the GameStop play, aside from Wall Street getting kicked in the teeth, even if it was temporary, is that because it was Reddit and because the company was GameStop and because the media gave it so much attention, it got a lot of new people that maybe didn't know how to start or didn't know where to start or weren't particularly interested in it. It got a lot of these people interested. I mean, our Wall Street Bets gained millions of followers in just a couple weeks. And if you read the comments, a lot of these people were new investors who had never bought a stock before. But because the coverage was what it was, and they all knew Reddit, and GameStop's an iconic company that a lot of people can relate to. I mean, a lot of us went to shop there when we were kids, and some of us still do now. And so it was extremely relatable. Like, if this was a pharmaceutical company and it was just a Wall Street hedge fund versus another Wall Street hedge fund, the media could have covered it, but no one would have cared. It wouldn't have got anyone excited or invigorated. And I think this was the perfect storm to help new people. Even if they did lose money, I hope it helps these people continue to grow and continue investing and continue improving and continue in saving for your retirement and your overall financial health. So I've been talking about it, so let's just jump into it. Here are the principles that I think are the best takeaways that we can apply to our everyday investment strategy going forward to make us better investors. So these rules or principles or takeaways or whatever you want to call them, when applied together and consistently over a long period of time, say from now until the time that you want to retire, can make you into a seriously successful investor. I mean, we're talking about hundreds of thousands to millions more in your account over time, meanwhile staving off losses that you would have potentially otherwise had. So let's get into rules number 1 and 2. Rules number 1 and 2 go hand in hand, and that is don't fight the trends and don't get greedy and cut your losses. Now, I know these can seem a little obvious from the outset, but one of the hardest parts about investing is not getting too emotional or too wrapped up in a trade, especially when you have a lot of money tied into it and you potentially have a big loss coming your way. Well, you could stave off some of that loss by following the trend, not fighting against it. Say, for instance, you bought GameStop at $350. Well, when it dropped to $200, you should have sold at least some of your shares. Now, I know that's locking in some of your losses, but frankly, the writing was kind of on the wall. We could see that the trend was going downward and it probably wasn't going to recover. And if a lot of people would have, instead of listening to the hold, and ride that rocket ship to the moon, if they would have sold and cut some of their losses, it would have helped you minimize the damage and live to play another day. Now, I know what you're saying, but Ben, it was a short ladder attack. And it might have been, but the information that we have or the information that is out there isn't always correct. And even though we might be right, it doesn't always dictate the market. And so when you're reading the trend and you're seeing a downward spiral, sometimes it's better to relieve the emotion of losing the money, accept that you already have that amount of money into it, and just cut your losses. So don't fight the trend doesn't just apply to stocks going down in value. It also applies to stocks going up in value. And now I know what you're saying. Well, yeah, if a stock's going up in value, of course I'm going to invest in it. But that's not always true. And GameStop's a perfect example of it. It started out at like $18 a share. And when it went up to 30, everyone was saying, well, I should have invested at 18, but now I can't because it's too expensive. And then when it went from 30 to 100, everyone was saying, well, I should have invested at 30, but now 100 is way too much. And then again, it went up to 300 and everyone wanted to invest at 300. And either they waited and they didn't invest at 300, which turns out to be a pretty good move, or they bought in at 300 and then it slid back down and they bought in at the worst time. And so you have to be willing to risk, if you like the stock and you like the price that it's at, you have to be willing to invest a portion that you could afford to lose if it goes wrong and it's not going to bankrupt you. But a lot of people don't get into investing because they think the market's a crapshoot and it's just a bet. And it's costing them millions of dollars at the time of their retirement because they didn't take advantage of things like compounding interest, all because they thought that they couldn't afford to risk the money. Now, single stocks are a riskier play in general. And so this brings us to point 3, and that is lock in some of your gain. A lot of people didn't do this with Reddit Wall Street Bets, and it's a really important principle because let's say you buy stock A at $10 a share and it goes up to 20. You can sell a portion of that off. You don't have to sell all of it, but it locks in a portion of your profit so that you can go and either double down on the stock. Don't typically recommend that. Or you can reinvest it into another stock that you like. And this can compound and work in your favor to where you're getting into more and more stocks and you're gaining and locking in your profit along the way. This is how you start compounding, specifically with single stock. Mutual funds and other funds like that are a little bit different, but if you're playing single stock, you want to lock in a portion of your profit, and then that way it's going to minimize your losses along the way, and you get to reinvest in another stock, all with money that you didn't have before. So number 4 is kind of multifaceted, but I think it's really important, and it's a lesson that a lot of these Reddit users maybe learned the hard way or didn't really realize at first. And so it's 3 parts. It's know your play, meaning know why you are investing in something, know what the actual play is so you don't get left holding the bag. The other portion of it is know who you're investing with and who you're getting your information from. And what I mean by that is if you went on Reddit during the height of it, when the stock was at $3.50 a share, everyone was telling you to hold and ride the rocket to the moon. Well, you don't know that person and you don't know why they're giving you that information, right? So if they bought at $3.50 a share and it's $200 a share, they could be telling you to hold or to buy because they need that share to go back up to $3.50 so they can get out and, at least break even. Meanwhile, you just bought a bunch of shares and you're left holding the bag. And that's exactly what happened to a lot of people. And so you really have to be skeptical of the information that you're getting or why it's being released. There's a thing called a pump and dump, and it's kind of what Reddit did, although not legally speaking, and I'm also not a lawyer, so I don't know if it's legally speaking. I guess they might go to court for it, but technically a pump and dump is where a group of investors talk up a stock. They hold a big position in it, they talk up a stock, hoping that it goes up in value or pumping it up in value, and then they dump out of it and leave everyone else that bought into it on the way up holding the rest of the shares. Now, technically that's illegal, but Reddit kind of did something like that on a smaller scale, only it was supposed to be them all buying at once to short out the short position, essentially, to disrupt the short position. And so it's really important to know where you're getting your information and who's giving you the information, because specifically in Reddit, the movement started getting manipulated because people had ulterior motives or people were infiltrating the thread, and a lot of people in the middle got hurt because they thought that Reddit was band together. Meanwhile, everyone was buying in at a different price point, and so they were just trying to get, at a certain point, they were just trying to get back to the point where they weren't going to lose as much money as maybe what they did. And you'll see in the media, you can make your own opinion about that, but you'll see that certain Reddit users, specifically the ones that started it all, made millions of dollars off of this. And those are the articles that you see, but you don't see all the people that are continuing to hold because the people that wanted to make millions, well, everyone wanted to make millions, but the people that made millions were telling them to continue to hold, or the people that bought high were continuing to tell them to hold. Meanwhile, they should have been selling all along because the writing was on the wall that this thing was going under. One of the perfect examples of this, aside from Reddit, is, and I've seen this a lot on Instagram, it's the Warren Buffett quote, or you'll see a glimpse of Warren Buffett's portfolio where it said, Warren Buffett invests into Coca-Cola. Well, if you take that and you say, well, Warren Buffett, he's a multi-billionaire. If he invests into Coca-Cola, that means I should. Well, you don't know what position Warren Buffett holds in Coca-Cola, and Warren Buffett's like 150 years old, so you also don't know when he bought in. Coca-Cola could be at its highest point when you hear that and decide to buy in, and it could be a completely bad play for you, even though Warren Buffett, a multi-billionaire, is also holding the same stock as you. So you really have to interpret the information, specifically with single stocks. You should never invest in anything that you don't know about, but specifically with single stocks, because instead of buying a mutual fund that has a bunch of different stocks in it, you're buying one stock. And maybe you're buying a bunch of one stocks, but you're buying one particular stock. So it's relying on you to get the appropriate information and know why you're giving that company your money. You have to know, is there enough information out there to determine whether it's going to go up in value, whether it's going to go down in value? And you can play either side of that, but you have to know why you're playing it, and you have to have an exit strategy. So guys, I hope you got some value or at least some entertainment out of that. But before you go, I wanted to briefly state why I started this channel. It's not just to talk about GameStop or single stock investing, or even because I'm a personal finance nerd who talks about personal finance all day, every day in my mortgage business, and decided to come home and also talk about personal finance. It's because, as I stated, I work in banking and mortgage, and I get to help a lot of people build their credit and buy their first home and buy their dream home. And it's really fulfilling. But on the opposite side, I also meet a lot of people who are struggling. And in 2020 and going forward now, it's really rampant. And it's heartbreaking to see the family who has bad credit that are just trying to buy a home or a safe home for their family to live in, or the 80-year-old retiree who is living on $1,500 a month Social Security and they have no other ability to make an income. These things, I'm not saying this to shame these people. These things are fixable and they're preventable. And I think on YouTube and through building a community on YouTube, I think there's a lot of value that we can add to each other's lives so that we can prevent these things and prosper in our lives and grow our overall financial health. And again, like I said, I want to have some fun at it. I don't want to just be sitting in front of a whiteboard writing down principles for you guys to learn like I'm a school teacher, because I'm not. I plan to do some interviews and some house tours and just some fun things that can get us invigorated and excited about our futures and our personal finance and how to move forward and support our families and just live the life that we want to live. So guys, if you did get some value or some entertainment out of this, please hit like and subscribe and hit the notification bell so you don't have to come find me again. I'll find you, not in a weird, creepy way. And then comment down below, how did the GameStop play out for you? Did you get a bunch of money and ride that rocket ship to the moon? Or did you lose a bunch and are now reeling and trying to figure out what the next play is? Or did you sit on the sidelines because you're not touching that with a 10-foot pole? Comment down below how it worked out for you. And again, like and subscribe. And guys, we'll see you on the next one.